And so, welcome to my economics channel. In today's video, what I actually wanted to do was go over a video by Economics Explained entitled The History of Global Banking, a Broken System with a question mark. I want to do an analysis and a little bit of a critique, and I want to elaborate on a lot of points made in this video, specifically because banking is an area that I'm really passionate about, and it's where I've done a lot of reading. And to that end, I actually want to show the sources that I draw upon for this video, because it's an area that I've been lax on in the past for my videos. But with that, let's get into the books. So we have Debt, The First 5,000 Years by David Graeber, The Great Divergence by Kenneth Pomeranz, China, Europe, and the Making of the Modern World Economy, Monetary Policy Operations and the Financial System by Ulrich Binsdell. Hope I said his name correctly. And finally, we have The Roman Market Economy by Peter Temin. And so with the sources out of the way, let's get into the video.
The world of banking is as hated as it is misunderstood.
This is actually an interesting point because banking is very often misunderstood, because without studying it, it is actually very difficult to understand how it works. But the main misconception behind banking, and something that I'll elaborate on, is that banks take in deposits and then they make loans through those deposits. That's simply not the case. Banks create money whenever they extend loans to people who they deem credit worthy. So they're creating the money supply. And this is hard to get your mind around because it's the private sector creating the money supply that we all use. But the main point is that we can't rely on the government to set the money supply for us. We need the private sector to determine how much money there should be in existence. And this is the role the banks play, and bank-like institutions.
The 2008 mortgage crisis was kicked off by major structural issues in the global banking system and exacerbated by record levels of household debt.
So this part's only partially correct. Yes, the crisis was exacerbated by record levels of household debt, and in fact we see consumers en masse trying to deleverage during the crisis, which of course did not help matters. But in terms of the start of the crisis, it actually wasn't the banking sector that caused it. Now, this is not to apologize for the banking sector or to say that it's blameless, but in fact, banks are very heavily regulated. And in fact, it was the shadow banking sector that precipitated the crisis. So what is the shadow banking sector? It's best thought of as bank-like entities, but that aren't regulated like banks. And so that puts them in the shadows. So the point here is that mortgage-backed securities were created by non-bank entities and that were then used as money by large institutional investors. Large investors were using mortgage-backed securities like they would a treasury. Both were AAA rated. However, once people started defaulting on their mortgages and the value of houses started crashing, then the underlying value of these mortgage-backed securities went down. When that happened, there was then a bank run essentially on the shadow banking sector. It then turned out that a lot of traditional banks were the backstop for these shadow banks. And this is where the problems arose. There simply was not enough money to be able to pay back the people who were trading in their mortgage-backed securities for actual money. So then the Fed had to step in, and then we get the crisis. Not that the traditional banking sector wasn't complicit, but banks were so heavily regulated, they could not originate these mortgage-backed securities. That was left to the shadow banking sector.
Banking as we know it today was forged in the foundries of goldsmiths.
Okay, so this part is fairly lengthy, but basically he says the goldsmiths took in gold deposits from people and then issued certificates. And these certificates could then be redeemed against the gold if need be. But most importantly, people just used their certificates as money. So the idea was that eventually an enterprising goldsmith could come along. He could create more certificates, a higher value of certificates than the value of the gold that he was taking in as deposits. So he was essentially multiplying up his money, if you will. And the idea was then this would cause instability, this would cause problems, and so on. But actually, this is not entirely accurate. So what we might call modern banking actually began with the Templars. What you had was the Crusades, and in particular the First, the Second, and the Third Crusades. They were very expensive affairs, and people were traveling thousands of kilometers to get to the Levant, or simply the Crusader states, also known as Outremer. But the thing is, because it's so expensive, you don't want to cart your gold thousands of kilometers, let's say from England or France, over to Jerusalem. You instead go to a Templar bank, deposit your gold, you get a certificate. With that certificate, you then travel down to Jerusalem, you then present that certificate of deposit to one of the banks down there, and they then can give you your gold there, and then you can spend it. But actually banking, in a much less formal sense, began much earlier. We have some tantalizing evidence that there were actually banking-like activities even in ancient Rome. You had wealthy people who were extending credit for people who were well-connected or rich, and oftentimes those two went hand in hand, who then could spend this credit as if it was money to then grow a business or start some sort of business venture, and they could pay back the wealthy person. The point was that the wealthy person was creating credit for someone else to use to be able to pull their spending from the future and pull it into the present. And this, for the well-connected person, was good because it allowed them to spend money today, create growth, and then pay back the person. The point here is that we've always been forward-looking as a species, and banks just help formalize this process in terms of credit creation. The reason I bring up ancient Rome is that these people were essentially acting as proto-banks. They didn't have double-entry bookkeeping, that would come later, but they were creating credit for someone else to use. That is extra money, that is extra credit that is created. And it's on the back of that all-important commodity of the economy, and that is trust. If you borrow money from that rich person, you could spend it because of the trust that someone else had in that rich person, that they were good for the money. And that is why that credit could be created. Then we get over to the creation of double-entry bookkeeping, and this is then where we start to see modern banking take shape. Because now you have assets, liabilities, and equity. And this is then where you could create money. I actually want to read a quote from the book that showcases what I mean. And it says, and this is quoting Tobin from 1963, and he says, "Perhaps the greatest moment of triumph for the elementary economics teacher is his exposition of the multiple creation of bank credit and bank deposits. Before the admiring eyes of freshmen, he puts to rout the practical banker. The banker is shown to have a worm's eye view, and his error stands as an introductory object lesson in the fallacy of composition. From the Olympian vantage of the teacher and the textbook, it appears that the banker's dictum must be reversed. Depositors entrust to bankers whatever amounts the bankers lend. To be sure, this is not true for a single bank. One bank loan may wind up as another bank's deposit. But it is, as the arithmetic of successive rounds of deposit creation make clear, true of the banking system as a whole. Whatever their other errors, a long line of financial heretics have been right in speaking of fountain pen money. Money created by the stroke of the bank president's pen when he approves a loan and credits the proceeds to the borrower's checking account." And then the book goes on to say, Tobin criticizes this textbook old view of the money supply for a number of reasons, and indeed, as argued in section 3.3, the associated money multiplier and money supply approach to monetary economics is hardly convincing. So the point here is that with the introduction of double-entry bookkeeping, banks could create loans, and that would then create money, because the bank would extend a loan and it would have that loan as an asset, but it would simultaneously create a deposit, and that deposit would be for the person who took out the loan. That deposit then is an asset for the depositor who could then use it as money. The point here is that money is created by the private sector for the private sector. And then of course we have the story of the goldsmith, but that comes later. Credit comes first.
Now, if a goldsmith wanted to loan money, they did not need to give out their own gold or even their depositor's gold. They could just write out these receipts. People understood that these receipts were exchangeable for their nominated value in gold, so they continued to trade with them knowing that they were as good as gold. What this let goldsmiths do was write more loans with a greater value than what they physically had in gold.
And this is seen as greedy or selfish on behalf of the goldsmith. But the point here is this: these goldsmiths could not just issue credit anytime they wanted and simply increase their profits. They could only issue more of these certificates if there was a demand for it. And that's the point of banking. We don't want to rely on the government to control the money supply. The government is simply too slow to react to the conditions in the economy. If you have a good business idea, we want you to start your business now. We don't want you to wait upon a government department to give you money. And this is why we rely on the private sector. And we've always tried to rely on the private sector of sorts. And so the goldsmiths issuing more certificates could only happen because there was an increased demand for these certificates. These goldsmiths were satisfying extra demand for these certificates. So the private sector needed more money, and so the goldsmiths were there to provide more money. And that is the point of banks today. Central banks control the price of money in the form of the interest rate, and the central banks then provide enough reserves for banks when they extend and create loans and ultimately create credit. So the point here is that it's not necessarily just nefarious or greedy goldsmiths that were then creating more certificates than they had in the value with their gold. The point here is that people trusted these goldsmiths And this then allowed more credit creation, which then allowed more activity, more growth in the economy.
Still, the threat of bank runs loomed ever present. So the solution was a central bank.
So to elaborate on this point, one of the big functions of the central bank was actually stability. Before the creation of the Federal Reserve in the United States in 1913, you actually had sharp periods of deflation and inflation, of course, where the money supply sharply contracted and the economy experienced several panics. And in fact, the banking panic of 1907 was particularly bad, and this provided a big push for the creation of the Fed. See, the thing is, in 1907, the system was bailed out by JP Morgan Chase. But the problem here is that he's a private person and he's bailing out the private sector, the private banks. But a central bank is a private and a public institution, which I think is the best of both worlds and is one of the reasons why central banks have the trust that they do. So we don't want to rely on the government to control the money supply, but we don't want to rely exclusively on the private sector either. So we want a hybrid institution, which is the central bank. So even though we don't elect officials that work in central banks, at least we elect the government, which then chooses those officials that work in the central bank. Of course, this system is not perfect, but I think it is a good compromise for the system of money creation that we have today, because roughly 97% of our money supply is created by the banking sector.
They would still fall far short of the multi-trillion-dollar monolith they are today. So where has this extra power and influence come from? Professor Richard Werner is an award-winning economist on this issue, and he notes that there is no value added by the financial sector, regardless of what kind of financial products they might come up with.
This part is actually somewhat correct. In the past 30 years, salaries in finance have grown disproportionately as compared to the rest of the economy, but it can be hard to see what value finance or simply the banking sector provides in terms of its size compared to the economy. And this role for finance and banking in the economy is something that we're going to have to question going forward. I don't think that banking can be the monolith that it is today. I certainly do think it has to change, and I do think the sector is somewhat bloated.
Being able to conjure something into existence that has value has made banks modern-day alchemists. And this is what Professor Richard Werner identifies as the turning point in global finance. Banks are no longer intermediaries, they are originators. The goldsmiths of yesteryear were a bit cheeky in writing loans with deposit receipts for gold that didn't exist.
I don't want to belabor the point, but the important point is that banks were always originators of money. They were never really that classical role or that classical idea that we have of banks, where they take in deposits and then they lend out money. They've always been in the business of creating credit, of creating money for the private sector, over and above the money that existed in the economy. They've always been there to help growth in the economy.
Today, modern banking systems are afraid that too many people will try to pay off their debt. There simply is not enough cash in existence to pay off all of the debt in existence.
Actually, this is a really important point. If we were to pay off the entire national debt, we would actually destroy all money, and we would simultaneously also destroy all economic activity. Money and debt is economic activity. The point here is that when the bank creates a loan and it also creates a deposit, the loan is a liability for you, but the deposit is an asset for you. And the opposite is the case for the bank. And the point is that we must, in the current climate, keep growing money. We must keep growing the economy. Of course, this is not something that can continue forever. I get that. But so far, this is how we have the modern world. We've created both. We've created money, we've created debt, and we've grown the economy. And most economists agree that so long as the rate of growth in the economy is greater than the growth of debt in terms of percentages, we can service our debts. It's not a problem. It's only when those two become reversed that we then run into problems. Think of money as simply a scorecard. If you're playing a soccer match and we then remove the scorecard, we then don't know how many goals were scored. If there's no scorecard to begin with, how are you going to play the game? And the same is true of money. If you don't have money, how are you going to get any economic activity? Of course, human activity existed before money, but it wasn't very complex. Once human activities and trade started becoming more complex, we needed money, we needed credit to help facilitate this. And that is the sense in which we can't pay off the national debt. And that is the sense in which money is activity and it is debt.
When it is remembered that all of this debt is also accruing interest, people would be forgiven for feeling a little bit concerned.
And yes, that is a big point. Because money is created with interest every time a loan is extended, there's an impetus to continually grow the economy. And there's this idea that the only way we can grow the economy is through competition for loans. And so when you get out a loan, you then have to do something with that loan. You can't just sit on it. And that something ideally is new activity for the economy that did not exist before. And that helps create growth. And that is the point of interest. The interest forces you into new activity. But it's not just you creating new activity, you're then competing against others. So there's essentially an arms race for new activity in the economy. And that is how we've got the modern world.
GDP measures the sum total of all transactions in an economy, whereas output measures the total value of things created in that economy. If someone were to make a table and then trade it back and forth 10 times with a friend for $10, they would have raised GDP by $100. In the same example, output is still only one table.
So I wanted to end this video on this part because this part is flat out wrong. So for GDP, you have the production approach, you have the income approach, and you have the expenditure approach. And these are all equal. But the point here is that there's no double accounting in GDP calculations. If multiple transactions happen on the same item, they are not counted. It's only counted once. And more specifically, it's only on the value added that we do the counting. So what do I mean by this? Well, let's go to his example, which is the creation of that table. If you as a private citizen create a table and sell it, well, that's essentially counted as a secondary market, and that's not counted in GDP. Now, that is a shortcoming of GDP, but it's not the way we count it currently. It's only when it's done at the level of the business that we then count that production. This is also true of secondhand goods. If you buy something brand new from a store, that counts towards GDP. However, you then selling that on does not count towards GDP because it's already been counted, but also it's in the secondary market. So the main point here is when a table is created, it's only the final value of that table that we care about. If you buy $50 worth of material as a business and you create a table and you sell it for $100, we count that $100 because it's that value added that we care about. The point here is that we count that table towards GDP because it's new production. Before you took that material and created that table, it didn't exist. And when you created it and when you sell it, that is new production for the economy. That adds to GDP. So that's actually all I wanted to say for this video. I agree with most of the video. It's just those few nitpicks that I had. So I hope that helped. I hope you found that interesting. Thank you for watching. Subscribe, rate, and share all the good stuff. It definitely helps my channel, and I'll see you guys next time.